Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 70, titled Comparing Call and Put Selling Strategies. We're going to use a real-life example with Paylocity Holding Corporation, which trades on the NASDAQ exchange under the ticker symbol PCTY. Now let's compare the advantages and disadvantages of call and put selling strategies. Now, selling call options with covered call writing generates cash flow. That's the main reason why retail investors and professionals as well use this strategy. It's a low-risk option selling strategy that will generate a cash flow into our brokerage accounts. Now, the strategy does require us to first purchase the shares. So for every one options contract we sell, we must first own 100 shares of the underlying security. Could be a stock or an exchange-traded fund. Now, the break-even point is lowered by the premium that we receive. Doesn't matter which strike price we're using, in the money, at the money, or out of the money. You subtract that from the price we paid for the stock or the price that the stock was trading at the time of the covered call trade. That is the break even at that point in time. Now, should we sell an out of the money covered call with a strike price higher than the current value of the stock, then we can generate two cash flows with the same trade. One from the option premium and the other from share appreciation from current value up to the out of the money strike price. That is the main reason for using out of the money calls, the two income stream potential. Now let's look at selling cash secured puts. That strategy as well is a low risk way of generating cash flow. And it's a great way to do it. So both strategies are outstanding approaches for generating cash flow. Now, instead of buying the stock, the broker will require us to set aside a certain amount of cash in our brokerage accounts in case that option is exercised and the shares are in fact put to us. How much cash will they require? Well, the put strike minus the put premium times 100 times the number of contracts. That's how much cash will be required to secure that put and to move forward with that put trade. So for covered calls, we first buy the stock. For selling cash secured puts, we're required us to put a certain amount of cash into our account in the event that that option is exercised and shares are put to us. Now, our break even is lowered by the out of the money strike. So in the case of puts, the strike price, if it's out of the money, is lower than current market value. So we're protected from the current price of the stock down to that out of the money price minus the put premium. So we have a pretty good amount to break even from current market value. However, when we sell cash secured puts, the maximum gain is the put premium. Whereas with covered call writing, we have the possibility of additional premium or additional returns from the current market value to the strike price if we used an out of the money strike. Let's get back to Paylocity, PCTY, in the July 2019 contract. So it's a 1-month contract. At the time, the stock was trading at 97.01. If we looked at a price chart during that time frame, we would see that the price was accelerating dramatically. So as it turned out, it was a great security to use for the July 2019 contract. Now, if we went to the option chain, we would see that the out of the money 100 strike, again, a 1-month return, with PCTY trading at 97.01, generated a bid price of $3.10. If we fed this into the multiple tab of the Ellman calculator, we would see that the initial return on our option, or ROE, was 3.2%. That's 310 divided by 97.01. Since the strike, the 100 strike, is out of the money, there's additional potential of 3.1% if the stock moved from 97.01 up to or beyond the 100 strike. So there's a potential 6.3% 1 month return in this particular case. And given the price chart that I alluded to before, that would have been realized. Now, let's take a look at this stock using cash secured puts. Now, we put into the BCI Put-Selling calculator the fact that PCTY was trading at 97.01. The 95 out of the money strike generated $2.05. So that's the premium we'd receive, $205 per contract. Now, the calculator lets us know that the initial time value return on the option or RU is 2.21%. Once again, we're looking at a 1 month return. So it's about a 25% annualized return. Since it was only 25 days, the reality is it's actually a 32% annualized return. And the calculator will give us that information. Now, if the price of the stock dropped below the 95 strike, now that strike is in the money, not out of the money. And if that happens and we take no action to buy back the option, then the shares will be put to us at 95. But what is our cost basis? It's not 95. We received $2.05 on the put premium. So our cost basis is actually 92.95. That is our break even. And the shares will be put to us at that price if the price of the stock drops below the 95 strike and we take no action. Because we can always buy back the put and then the shares will not be put to us. But if we take no action and that occurs, that means we will have purchased PCTY at a 4.19% discount from the original 97.01 price when the trade was initiated. All this information will be given to us with the BCI Put-Selling calculator. So you can see that the downside protection is very significant. Let's summarize. Both of these strategies, covered call writing and selling cash secured puts, are outstanding ways to generate cash flow in a low-risk manner. Now, in favorable market conditions, we would benefit from selling out of the money covered calls because we have the opportunity for a two-income stream potential when we use these higher or out of the money strike prices. In a declining market, the out of the money put selling strategy will generally result in a lower break even because there's going to be a distance between the current market value and the price that we're agreeing to purchase the shares for, plus the put premium on top of that. So it'll give us usually greater downside protection. Now, we can also get additional downside protection with covered call writing by selling in the money call options. So if our preference is simply covered call writing without integrating selling cash secured puts into our overall strategy, and we're defensive or we're worried about a volatile market, or if it just simply helps us sleep better at night, then we can definitely go within the money call options. Now, in a defensive market, I also enjoy using the PCP strategy. Some people call it the wheel strategy, where I first sell an out of the money cash secured put, and then if and when exercised, move on to writing a covered call. So you can integrate both of these strategies into one multi-tiered option selling strategy. But you can get that additional downside protection to some extent within the money covered calls. So we have the opportunity to use really any of three strategies: covered call writing, selling cash secured puts, or the multi-tiered, where we're integrating both of these strategies into one overall strategy. Okay, once again, as I always conclude these podcasts, I want to remind everybody to take advantage of the huge amount of free resources on our website, www.thebluecollarinvestor.com. Look for the free resources link on the top black bar of all of our web pages. Have a look also at the Beginner's Corner training videos for both covered call writing and selling cash secured puts. There are a multitude of blog articles, hundreds of them, that I've published over the years. There's also a glossary for covered call writing you may want to bookmark, and many, many, many more free resources on the site. If you go to our blog page, you can also sign up for our free weekly newsletter, which if you do sign up, will be sent to your email box every Sunday morning at 10 a.m. Eastern Time. Also, we have huge amount of products in the bluecollarinvestor.com store, which includes online video lessons. We have them both individual and bundled with downloadable workbooks. We have our books. We have 8 books. 7 of them are published in hard and soft cover versions. We also have ebooks, as well as calculators, spreadsheets. We have a trade planner, as well as online mentoring programs. So there's a lot of tools available to you so that you can master both of these strategies, covered call writing and selling cash secured puts. Ladies and gentlemen, thank you very, very much for taking the time to listen to this BCI podcast, number 70, comparing call and put selling strategies. Hope you enjoyed this podcast, and most importantly, I hope it puts some cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.